Good afternoon and welcome to Scotia iTRADE's webinar. Today's topic is on getting started with call options with Pro Market Advisors. My name is Conleaf Lyons, the Client Education Specialist with Scotia iTRADE, and I'll be your facilitator for the next 60 minutes. Just before we get started, I'd like to just take care of some quick housekeeping items, and then we'll dive right into the presentation. So you should be able to hear, but just to test your audio, simply click on the sound check link in your audio panel as shown on the screen. It may show up as a settings link. Your setup window may appear on your secondary screen if you're using two monitors. If you are having any issues with the sound, you can always use the hand icon just to let me know, and I will see if we can have that addressed for you. And as always, everyone is muted for sound quality purposes. Now, if you've joined in using your computer and you're having audio issues, you can always switch over to the telephone, give us a phone call using the telephone number you see on screen. Also, don't forget the access code and your audio pin ID when you're calling in. So as a quick reminder, unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products or services, third-party content, or investment loss arising from any use of the content, including third-party content. So the information that we're sharing with you today is for general information and educational purposes only, and it's not intended to provide personal investment advice or any recommendations. We don't take into account any of your specific objectives, so just keep that in mind as we go through the slide. Informational and educational purposes only. And as a quick addition to that, options, if you don't mind, options involve risk. They're not suitable for all investors. They are intended for sophisticated investors. So before trading options, please carefully review the options account agreement contained in the Scotia iTRADE relationship disclosure document and the terms and conditions. I've put a link here on the page, but this information can be found under our forms and documents page on the scotiaitrade.com website. So today you will be able to use the GoToWebinar control panel as well. The orange arrow that you see on the top can be used to hide or to show the control panel, so let's keep that in mind. You can always also view in full screen mode by using that icon as well. Now, if you've got a question, you can use the hand icon, but preferably you should just use the question panel. Just type in your question in the question panel box, and I'll be able to route those over to our presenter, who may elect to answer the question immediately, or depending on the nature of the question, may do so in the question and answer session at the end of the presentation. Also, as a quick reminder, we are going to be recording today's session, so you will be getting an automatic email link tomorrow, and say the mid-afternoon, with a link to the recording. Alternatively, you can always visit our YouTube channel. We've got a Webinars on Demand playlist there where we have some archived webinars. So you can always go and visit that, review the archived webinars that are there. If you are still unable to locate your information, just email me at education@scotiaitrade.com, and I'll be able to provide you with a link to the presentation. I'll show that email address as we move forward. One other point then to keep in mind, I will be uploading a PDF file at the end of this presentation. So once we finalize, please just hold on for another 30 seconds or more. I will upload the PDF presentation into the GoToWebinar tool. Then you'll be able to download that onto your own computer. If that doesn't work for you, just email me again at education@scotiaitrade.com, and I will actually send out the PDF for you. So today we are fortunate to have with us Sean Howell. He's with Pro Market Advisors. Sean is an accomplished speaker, trader, author, and educator. He is a CBOE Master Instructor and co-founder of Pro Market Advisors. This is a consulting firm that serves as the primary educator for iTRADE. Over the past 2 decades, Sean has held executive positions with some of the financial industry's leading brokerage and trading firms, including Charles Schwab, InvestTools, and Think or Swim Group. Sean is the co-author of Trading by Numbers, which is a scoring strategy for every market, published by Wiley in 2012. He currently serves on the central coast of California with his wife and 2 children, where he continues to trade, consult, teach, and design educational curriculum for traders at all levels. So I'm pleased now to hand over the presentation to Sean, who will then instruct us for another 45 or so minutes. Sean, over to you, my friend.
Great, thanks. Thanks, Conleaf, and everyone, thank you so much for joining. I certainly love teaching options and love teaching the getting started strategies, because hopefully it's going to start to get a little bit of a glowing light bulb above your head, and that is what this session is designed to do, is to get you thinking about ways to utilize options as sort of a stock replacement strategy. So let me get ready to present here, and let's see, be sure I am sharing the right thing here. All right, let me get my PowerPoint going. And let's see. Okay, you should be seeing my Microsoft PowerPoint presentation right about now. All right. So what we're going to do a little bit different here is the presentation that I've got is the introduction to options. And Conleaf and I were having a discussion that when we try to cram in calls and puts in the same session, it's too much information coming at you. It's sort of the drinking from a fire hose, and that's not what we want to do. So what we're going to do is slow everything down a little bit today, and we're going to focus this section on, I should say, this session on call options. So I'll go through a little bit of a lecture, and then I'm going to switch over to Scotia iTrade's .com platform, the more basic platform. Flight Desk is phenomenal, but we're going to keep it nice and simple. We're going to look at an option quote. We'll talk a little bit about the pricing of that option. We'll talk a little bit more about some other data points within that option, things that are called Greeks. We'll talk about that briefly using some real-world examples there, and then talk about the order entry and then the order exit as well. So hopefully it sort of encapsulates a little bit of learning, a little bit of live education, and then a little bit of actionable content as well. So that is the goal, and with that I need to get us rolling. So a stock option is a contractual right or obligation. Today I'm only going to be talking about rights. I will not be talking about obligations today, so we'll keep it simple, but definitely down the path you'll want to learn about getting on the side of an obligation. That would be things like a covered call, and the reason you would be on the side of an obligation is you are utilizing options generally as some kind of an income strategy. And every time I poll people and ask how many of you would like strategies on income, there's a whole bunch of hands going up in the air or electronically going up in the air. But today we're talking about having rights. So it's a contractual right to buy or sell. Now, I'll be talking about calls today, so we'll be talking about a contractual right to buy shares, not sell shares. That'll be the put side of it, and that'll be a future webinar. To buy a specific number of shares at a defined price. We'll talk about some of the language here shortly. For a defined amount of time, options don't live forever in theory, like owning shares would, in exchange for money. And because you'll be buying a right, you will be paying the money. But if you're selling a right, and again, that's something down the road, you'd be receiving money. So if the obligatory side is getting income, then the side that has the rights and not the obligations is paying out that money. And really what you'd be doing here is you'd be speculating on a stock move, and you'll see what I mean as I get into this. But let's go ahead and define a couple of the key terms. So stocks trade in shares. That's just sort of something everybody knows. Hey, I bought 1 share of Apple. Hey, I gave my kids 10 shares of Walt Disney for graduation. You know, whatever. People understand the idea of shares. But options are not traded in shares. Options are traded in contracts. So if I say, hey, I bought one contract, that one contract, which is, by the way, the smallest amount that you can buy, that one contract represents shares. And that can throw people off a little bit, because when we look at the quotes, you'll see that the quote is being provided in a per share amount. So if I see that the quote on a contract is $2, well, the contract doesn't cost $2. That quote is a per share amount. So if I buy one contract and the quote is $2, the contract is going to cost me $200. You just need to multiply, that's all. So we've got two types of options. We have calls and we have puts. Today we're going to be focusing on buying calls. So if you are the call buyer, you're going to have the right to buy shares. Now, very quickly, I'll jump ahead of myself and I'll say, but almost nobody, well, we're talking like 85% of people do not actually buy the shares. Instead, they're going to trade the value of the call option. If they buy a call option for $2 and the stock goes up, and because the stock went up, the call option went up as well, let's say that the call option went from $2 to $3, then people sell the call option and they get their profit that way. So most option traders do not do any of the transaction in shares. They simply realize their gain or their loss from the change in value of the call option as well. We'll skip over puts, but it is in this deck, and again, that can be something we cover later. So when we're talking about buying and selling call options, we use the language of premium. So if you are buying a call option, you pay the premium, and that's the money the option buyers are paying to buy the contract. And if you, at the end of that transaction, hopefully it's profitable for you, and you go to sell that contract, then you'd be getting a premium back again. And again, options have defined lifespans. They can last a number of days, they can last a number of weeks, they can last a number of months. Weekly options and monthly options are definitely the most popular options, but there are options that go out a number of years. Again, the language is a little different for an option that goes out more than a year. It's called a leap in that case, but besides a slightly different name, it's pretty much the exact same thing. And that's something that you can take a look at in the future for maybe a longer term stock substitution strategy. And then also there's what we call the strike price. And this is probably better that you see this as we get to the slides, but the strike is the price at which shares could be bought or sold. But just remember that almost nobody buys these shares. Instead, they are trading into the option and out of the option, and it is the trading of the option that allows them to either realize their profit or not realize their profit and unfortunately experience a loss. So some basic terms for you, and we'll be applying that throughout this session. Now, real quick matrix here. As I talked about, you're going to be, in this session, thinking of yourself as the buyer of the option. And as the buyer of the option, you're going to be paying a premium. You have rights. You may exercise that option and buy shares, but most people do not. Instead, most people will sell that option. They'll buy to open the option, and then to get out of the option, they will sell to close, and you'll see that as we get to the screen. But this matrix allows you to get a better handle on what's the buyer have the right to do and what does the seller have an obligation to do. But really, it's not important that you understand the seller's obligations right now, because we're not talking about that as a strategy. We're talking about buying the calls. So really, there's three things that we could cover as you sort of get started with options. And I think it's important that you understand when you have an upside or a bullish opinion, that you understand how to be long a call. In other words, you buy a call option. You'll hear people say this sometimes. They'll say, hey, I'm long Apple stock. And what that really means is that they're bullish on Apple stock, and therefore they've gone and they've bought Apple shares. So if you say, hey, I'm long on Apple stock, I am long on Apple, so therefore I have gone long calls, that means that you're bullish on Apple, and it means that you have bought calls. So long calls is sort of a option speaker's way of defining what their strategy is. And if you have a downside opinion, in other words, if you're bearish, then you'd be long puts. But again, we're not covering puts in this session. And kind of the neat thing is you learn both calls and puts, is that you can build a strategy that says, you know, I don't know which way the stock is going to go, It could go up, it could go down. In fact, I'm very confident that in this amount of time, the stock will either go up a lot, in which a call option would make you money, or it will go down a lot, in which a put option would make you money. And so therefore, you end up being long both a call and long a put, and that's called a straddle. And again, that can be an entire session in and of itself, which is probably best. But I want you to be aware that you can do those kinds of things. So let's walk through this real quick. So this is what most people are comfortable looking at when it comes to being bullish on a stock. So we'll use sort of a stock example first, and then we'll switch it over and we'll use a call example instead, sort of a substitute. So current price of the stock, 20 bucks. Now take a look at this trend. You have to understand a little bit about how I like to trade. I'm more of a momentum trader. In other words, when I see a stock that has been going up and has consistently been going up for some time, I tend to believe that there will be a higher probability or higher likelihood that that stock is going to continue to go up. In the same way with a bearish trend, when I see lower highs and lower lows, and possibly on down days I see higher volume, and on up days I see lower volume. To me, that is a momentum trade that is indicative of sellers having more control over the stock than the buyers. So I'd be apt to be bearish on that. But in this case, we're looking at a bullish trend. So if I see higher highs, and again, if I had a volume analysis, which I don't on this slide, but I like to look at volume, and I see on up days higher volume than down days, I would surmise that the buyers are in control versus the sellers, and those buyers are going to continue to demand the stock from the sellers, and the way they're going to get the sellers to sell them those shares is they're going to offer higher and higher prices, which of course will lead to higher and higher moves. And if I buy a call option as the stock goes higher, the call option's value should also go higher as well. So that's the general concept behind it. But let's take a look at a stock trade instead. Current price is 20 bucks. Obviously, based on what I just said, you think the stock will continue to go higher. So you decide you're going to buy your 100 shares, and then we can sort of walk through the P&L. If you just bought 100 shares at the current price of $20, you can see in the upper right-hand corner, the break even is 20. Well, it's not really, because we know that you got to pay for commissions. Even if they're low commissions, it still is a cost of doing business. And there's also something called the bid-ask spread. If you bought the stock for $20, it's not worth 20. It may be worth $19.99, but there's always a slight differential between what you buy something for and then if you change your mind and turn around and sell it. The bid-ask spread on stocks tends to be very tight, especially if there's a lot of volume in that stock, which is called liquidity. Now, with options, bid-ask spread is typically larger. I like to look at stocks that have a lot of volume, because if the stock has a lot of volume, generally speaking, there's also a lot of volume in the option. The more volume there is in the option, the tighter the bid-ask spread is. I don't like looking at an option that has an ask of $2 and had a bid of $1. That's a very illiquid option, and that means as soon as I buy it, if I just spent $200 for it, if I at the same moment have a change of heart and decide to sell it, it's only worth $100. Just because the bid-ask spread, I could lose 50% of my value. So we want to look at options that have a lot of liquidity and have tight bid-ask spreads. So in this case, the break even here, I'm just going to keep everything simple, and we're not going to look at commissions. We're not going to look at bid-ask spreads, so I can drive home the point. Break even, 20 bucks. If this trade goes horribly wrong, the most you could lose is what you put into it, 2,000 bucks. Okay, I think we all know that. How much could you potentially make? Well, the maximum gain here, of course, is unlimited, and then I have a hypothetical loss in here using stop orders. But again, that's more stock mentality than it is options mentality. So let's get into using a call option for the same general strategy and what we gain by doing that and what we give up by doing that. So a call option is a tradable agreement. In fact, most people that buy an option will trade out of that option before expiration because they really don't want to buy or sell shares. Instead, they're going to use the option as their vehicle. This is why options are called derivatives. They are derived from the underlying stock, exchange traded fund or index, and as that stock, ETF, or index moves, the option will also move with it too. Not in direct step, but it'll move in a relationship to it, and that relationship, we'll take a look at that, is called the delta, is how we can assume what the relationship is going to be. So it's a tradable agreement that entitles the owner, that would be the person that bought the call option and paid the money for it, the right, you don't have any obligations, that's somebody else. You have the right to buy a stock, exchange traded fund, or an index at a specific price, that's called the strike price, within a specific time frame. As I mentioned, there are expirations to options, and we'll go into that very example next. So instead of buying a stock, we're going to use the call option as a stock replacement strategy. Same chart that we talked about here. The current price of the stock is $20. Same mindset, you think the stock is going to go higher, so instead of buying shares, you decide you're going to buy a 1-month call option, and you're going to buy the call option that has a 20 strike. So in other words, you're going to buy what's called the at the money option. It's at the money because the stock is at 20, and you're buying an option that allows you to buy it at the current price, which is 20 as well. So we're keeping this nice and simple, and we're going to buy an option that has basically 30 days of life, and for that we're spending 50 cents per share. That's how it would be quoted. Asking price of 50 cents. Now remember, that doesn't mean that I can buy a contract for 50 cents. I have to do the math. The contract represents 100 shares. 100 shares times 50 cents per share would equal $50 per contract. Now the nice thing about this is if you look in the upper right hand corner, let's drop down to maximum loss. If you were wrong, the most you could lose on this is 50 bucks. So that's how much skin in the game you have. So right away, by picking an option over stock, you have lowered your equity risk. So that's definitely a good thing, and people like that. And look at the maximum gain. Well, the maximum gain, just like the shares, is technically unlimited, but you don't have unlimited amounts of time. You're only buying an option that has 30 days of time, and there would have been an option that had 60 days of time and 6 months of time and maybe even 3 years of time. But in this case, in our example, we're just going to buy a little bit of time. We're going to buy a little bit of action in this stock. Now, when we bought that call option, what were we really buying? Was there any real value in the option? Was there any what we call intrinsic value? And the answer is no. If the stock is at 20 and I have the right to buy it at 20, but I'm paying 50 cents per share for that right, what is my 50 cents buying me right now? Well, it's only buying me 30 days of time and hope. So I take that, if all it's buying me is time and hope, I take my current strike price of $20 and I add what I paid for that contract of 50 cents, and that gives me my break-even point. So in other words, at 30 days out, if the stock is higher than $20.50, I'll be making money. If it's lower than $20.50, I will be losing money. Anything over $20.50, and I'm a happy guy because I'll be making money at expiration. So if we go through this little upper right-hand corner matrix, the stock price is 20, the break-even is 20.50. So I need the stock to go up over the next 30 days from its current price of $20 to at least $20.50. If it doesn't go to $20.50, I'm going to lose money. Well, but how much money could I really lose? Well, I could lose 50 bucks what I paid for it. And also another point is when people say, well, how much money do I need to have in my account to do this trade? You need to have 50 bucks. Now, again, I'm not including commissions in this, so you need to have $50 plus the cost of doing the transaction as well, and Coneleaf can answer that as far as what the total transaction cost would be. During this 1 month that we, in theory, have control over the stock, maximum gain is unlimited. And, you know, hypothetical loss, you'll notice I have a question mark there. When you're using a vehicle like an option, Do you really need to have an automated exit? Do you need to use a stop order? And I think you could present a pretty strong argument that no, by using an option, you're already limiting your risk compared to what it would be if you used a stock. If I go back a slide and you look at the maximum loss on the stock, the maximum loss on the stock is $2,000. So really, we are reducing our risk from 2,000 down to 50. But everything changes. We only have 30 days of control of this stock, and I need it to go up in order for me to make money. If it doesn't go up, if it goes sideways or goes down, I'm going to lose money, but the most I could lose is 50. So that's how that trade works out. Now that we've entered the trade, the stock can only do three things over the next month. It can go up, which is what we would like to have happen. It could go down, which we would not like for it to happen, or it can go sideways. So let's run through these scenarios real quick. So scenario number one, which is exactly what you want to have happen, is that over the 30 days, the stock rises. So here we are on the last trading day. Now remember, most people don't want anything to do with shares. Most people are simply going to buy the option, hope the stock goes up, and when the stock goes up, it increases the value of the option, and before expiration, they will simply close out their option contract and they'll walk away with their profit. And that's the example that's in front of you right now. So on the very last trading day, here we are 30 minutes before the market closes. You look at your stock and you say, that's great. Stock went from 20 to 22 bucks. Man, that's great. That's a 10% increase in 1 month. Happy day. How does that increase in stock affect the value of the option? Well, if you have the right to buy a share at $20, in fact, to buy 100 shares at $20, because remember, it's one contract, if you could buy that share at 20 and then turn right around and sell it for 22, I think you can see that you would have a built-in profit of $2. And you don't need to do that because the options market will reflect that true value. And again, that true value is called intrinsic value. So your option has $2 of intrinsic value, which means the options market is going to reflect the intrinsic value, and so therefore your one contract has a value of $200. So based on that, here we are 25 minutes before the market closes. You don't want to do anything with the shares. You are ready to close your option, so you sell the call option to close the position, and you sell it at $2, and that means that you bring in $200, but you got to remember that's not $200 of profit because you spent $50 on the trade. So it is profitable, and the profit is $150, not including commissions. So think about that for a minute. You paid $50 for a contract, and then you got your money back, and then you got another 150 profit. So you got a 300% return, and the stock didn't go up 300%. So why is that? And that's because options have leverage. That's the beauty behind a trade like this. And you should be able to calculate something very simple. So if I said, let's just run the same example, but let's say that instead of the stock being at 22, let's just say that the stock went up a little bit. How about it went from 20 to $20.95, okay? What would the option be worth at expiration? Well, if you have the right to buy it at 20 and the market is $20.95 and there's no more time left in the option, then the option will have a true value of 95 cents times the 100 shares I have. Okay, that means the contract will be worth at expiration $95. I paid 50 for it. That's not a bad rate of return. I know we're not talking about a lot of money, but again, I want to illustrate the point of how an option is going to be valued at expiration. So at expiration calculations are very easy. Now, what about scenario 2, where the stock, instead of we talk about it over 30 days, we look at the stock rising very quickly. So we buy our option, and then, hey, the stock moves faster than we thought it would, and 2 days later the stock is at $21. Well, an option is valued based on really two components. And one of the components is intrinsic value, which is true value, and we just talked about that in the previous slide. But if there's time left in an option, then the market's going to place a value on that time. So in this case, if the stock is at 21 2 days later, well, what's the intrinsic value of the stock? It's very simple. If you have the right to buy it at 20, it's at 21. I know the option will be worth at least $1. But I pull up iTRADE website and I look at the option chain and I see that the option is actually worth $1.45 per share, or 145 for the contract. Why? Where did the other 45 cents come from? Well, the other 45 cents came because of the extrinsic value, or the remaining time value of the option, the remaining 28 days in that contract. And you'll notice I have a question mark there. Option value of 145 question mark. I know it's worth $1, but I don't know what 28 days of time is going to be worth. It could be worth 47 cents, 40 cents, 38 cents. I don't know, because there's no way to ascertain exactly what someone is willing to pay for 28 days of time. But I know what somebody is willing to pay for $1 of value. They're willing to pay $1. So in this case, let's just say that it was worth $1.45. If you want to close the trade out, fine, you could do it. Stock price is at 21. Your option has a value of $145. You spent $50 on it. You say, I'm going to sell it. You sell it to close at $1.45. That means you walk with $95 of profit. So many people will close out options early. That's entirely something that you can do. How about scenario 3? Let's take this one for an example here. So we went through 2 scenarios in which it worked out. Let's go through some scenarios where it doesn't work out and you end up losing money. So over 30 days, the stock goes up, but then it goes back down. And on the very last trading day, the stock is still at $20, or right back at $20, I should say. Well, what's the option worth? Well, let's break it down. The option doesn't have any intrinsic value, so the intrinsic value component is 0, and there is no more time. It's 1 hour before the market closes, the day of expiration. There's no time value. So the option has no time value. It has no intrinsic value, so it's at 0. In other words, your call expires worthless. There's only a little bit of good news associated with this, and the little bit of good news is this: there's no commissions. It expires worthless. You only lost $50. So that's the good thing about it, no commissions, but the stock went sideways and you lost money. Now, contrast that, or compare and contrast that, to if you bought shares. If you spent the $2,000 and bought the shares, well, the stock is still at 20. You haven't made money or lost money, but remember, you lost 30 days of time, and of course, time is worth something. We know that as well. So you got to sort of go back and forth between what would I rather have in this situation, a $50 loss and I move on to the next trade, or I'd rather still have $2,000 of stock and $2,000 at risk in a stock that's currently going nowhere at all. You know, that's up to you to make that determination. So that's the stock going sideways. Scenario 4.
Sean?
Yes.
Oh, sorry. We have 3 questions.
Oh, okay. Great.
Okay, great. So James asked, and I believe this may relate to scenario 2. Can you sell it before expiry date?
Absolutely. The option, as long as the market is open, it's a liquid instrument. So you can sell it. Many people do. It's sort of like, well, there's profit. I'm going to take it and go. You grab it anytime you want. And that's the same for if you're in a loss situation. And that's actually going to be one of my next examples, is that if you buy the call and it starts going against you and you say, this isn't looking good, I want out, absolutely. You can sell it, and you can close it, I should say. You can close the option by selling it, take your loss or take your profit, and you're done. Just because you bought a 30-day option does not mean you have to stick it through to the end, not in the least bit. Great question. And Conley, I'm not seeing the other one, so you probably will need to read it to me. Yep, I'm not seeing it on my side. So if there is another one, by all means, interrupt me and let's get that one. Okay. So scenario 4, this is a slightly different one in that the stock has gone up. We went from $20 to $20.15. So remember that our break-even point was $20.50. So you may be focusing on $20.50 the whole time and thinking about that $20.50 the whole time, but the stock is only at $20.15. So you're thinking to yourself, I don't care about this trade. Well, you should care about the trade because the option does have some value in it. At expiration, the stock is in the money by 15 cents. So therefore, the stock is worth 15 cents per share or $15. So what you need to do prior to the market closing is you will need to close that trade out. Notice in the lower right-hand corner, any option that is in the money by at least 1 penny, and this option is in the money by 15 pennies. So if you did not close it out, then what would happen over the weekend is you would end up being the owner of shares. And again, most people that are trading options don't want to be the owner of the shares. They are simply going to trade in and out of the call option. So what you would need to do is simply close it. Same thing as we did on scenario 1 and 2. Sell it to close. It's worth, in this case, it should be worth right at about 15 cents per share or $15. It did go up. It just didn't go up enough for you to be profitable. So you paid $50 for it. You closed it for $15. You lost $35. You would actually lose more money than that because of the commissions to go in and out. But the point is you need to take action prior to the option expiring. Otherwise, you would end up owning shares, and you don't want to own shares. So that's the idea behind scenario 4. And then scenario 5 is very simple, and it's you bought the call option, and over the 30 days, the stock went down. So your option's value at expiration, there is no intrinsic value, there is no time, so therefore your option has 0 value. You don't need to do anything. The option expires worthless. There's no commissions. It just dies essentially, and you lose $50. So scenario 5 is as bad as it gets. But I want to point out that if you own shares and the same situation existed, well, you didn't run out of time, but your position that was worth $2,000 is now only worth $1,700. So you have a unrealized loss of $300. You have to ask yourself, under this situation here, would you rather own shares in which you hope that the stock is going to come back over the next week, month, year, decade, whatever, or would you rather have an option and be out $50 and then be on to the next trade? And that's something that I certainly can't answer for you, but for me, I don't like living off of hope that a company is going to come back again. I would rather use my option, get in. If it doesn't go my way, lose $50 and move on to another trade. That's how I tend to look at this type of trade. And let's pop into the final scenario here. Well, almost the final scenario. And this is where the stock falls quickly. You get in the option, the stock starts going down. It goes the opposite direction of what you thought. You're watching the option value, and of course, as the stock is going down, and every day that it's not going up, your option value is decaying. So you look at the quote and you say, man, here we are 3 or 4 days later, and the option that I paid $50 for, or let's make this more exciting, the option that I paid $5,000 for is only worth $2,500. I've lost 50%. I want out, no more. Okay, then close it. You could sell it to close, and that goes back to the question of, can I close it any time? Yes, you can close it any time as long as the market is open and the options market is open the same hours as the stock market as well. So yeah, no mas, get me out of this thing, no problem. You close it out. Unfortunately, you've lost, based on this scenario, 50% of your value, but again, the stock has not dropped 50%. It's dropped 10%, but options, again, being leveraged vehicles, are going to exaggerate the moves to both the upside and the downside. And then scenario 7 is the one that most people don't do, but absolutely you can. So scenario 7 is that over 30 days, the stock does something quite impressive. It goes from 20 to 23, and then you say to yourself, man, this thing is really a strong company. I wish I had more time. Okay, remember, with the call option, you have the right to buy shares. So you decide you're going to exercise your right. So instead of selling the option, you exercise your right. So you call Scotia and you say, hey, look in my account. You'll see I have a call option, and you can see that I have the money to exercise that call option. So, and what I mean by the money is, if you're going to buy 100 shares at 20 bucks, you need to have $2,000 in your account. So you exercise the option, you buy your 100 shares at 20 bucks, and that costs you $2,000. But remember, you also paid for the option. So the total cost to acquire those shares is $2,050. And then moving forward, you don't have an option anymore. Instead, you're a shareholder, which sort of takes us all the way back to, the original slide, which was you think the stock's going to go higher, so you buy shares. So I like this strategy in that it lets people sort of test the waters and put a little bit of equity to see if the stock is going to continue to perform. And if it does continue to perform, you may elect to go ahead and exercise your right. Fewer than 10% of people do it, but I think it's a very viable strategy to test drive a stock, try before you buy, and that can be particularly appealing when you are looking at maybe some IPOs. So I'm going to switch now and go over, and I'm going to share with you my screen. So let me stop sharing that. Conleaf, how's the sound coming through? Are we still nice and clean?
Still okay. There were some additional questions, if you don't mind.
I don't mind at all.
Bring those forward. Sean?
Yeah, I don't know if I can. Let me see if I can see them here.
No, you probably won't be able to see them.
Yes, go ahead. I'll be switching screens, and just go ahead and if you ask, I will answer.
So John is asking, to whom are you going to sell the option? How do you know there are buyers when you want to sell?
Yeah, that's a good question, and we could go into great detail on it, but there will always be buyers for the same reason that if you happen to have a gold coin that's 1 ounce of gold coin and you pounded it with a hammer and that gold coin got really beat up, and somebody said, ooh, boy, that gold coin is really, really beat up, and you say, who cares if it's beat up? It's an ounce of gold, and you see that an ounce of gold on the market is $1,300. Someone may not be willing to give you $1,300 for a beat up 1 ounce Canadian gold coin, but they may give you $1,295 for it because that's a guaranteed profit to them if they smelt it down. So people always like to worry about that. It will be worth not just what the market's willing to pay for it, but it will be worth pretty much very close to its intrinsic value. So if its intrinsic value is $1, the market will pay you something like 95 cents for that $1 of intrinsic value. And that 5 cents is basically what the market makers on the Chicago Board Options Exchange, that's how they make their money. They do thousands of nickels and dimes, tens of thousands of nickels and dimes every day. So in my example where I say if it has $1 intrinsic value, you'll get $1, that's not quite real world. You'll get 95 cents, 97 cents, something close to that. So just know that nobody is going to pass up on free money. In fact, I'll give anybody on this call, 95 cents for a $1 US bill. It just has to be a real US dollar bill, right? It's an arbitrage situation if it was anything different. So I hope that answers that question. What else do you got there, Conleaf?
Okay, great. So I have another one from James. When you close the option, who is the buyer?
Same thing. When you close the option, it's typically a market maker. It's you, it's me, it's other retail investors. I'm dancing around this, and here's why. It doesn't matter. The markets are extremely efficient. So what the other person is doing should not be germane to your decision. If you look at the value of what the bid is, again, going back to my ounce of gold, if it's worth $1,300, someone is not going to pay you more than $1,300 for it, but they'll pay you very close to $1,300. Why they're doing that? Doesn't matter. They're doing sort of the same thing you are, just on the other side of it. We could build a whole presentation of what's going on the other side of my transaction, but you'll be there one day instead, and you'll understand why you are doing it and how you're going to make money. Slightly different perspective.
Okay, just two more questions. I hope we have enough time.
Yeah, I'm not going anywhere.
Okay, great. She wanted to go back into scenario 5. If you allow the option to expire, will you only lose money or more than that?
If you let the option expire, scenario 5. Okay, so this is scenario 5. I believe was. I'll have to go back to my slides here. Let me look at scenario 5 real quick to be sure I've got it. Scenario 5 was. Let's see. Going back here. I know you're looking at my other screen. So scenario 5 is the stock falls and the option's held to expiration. So at expiration, the stock is at 17. If you put $50 into that transaction, you bought your one call for 50 cents, and at expiration, the stock's at 17, there's no way it's going to have any value at all because it has no intrinsic value and no time value. So letting it expire in your account, you're the one that has the right, not the obligation. Nothing happens. You basically lose your 50 bucks. More than that because of the commission going in. Just remember, no commission going out. So hopefully that answers that question. You don't need to do anything at all.
Great. Now, Ken is asking a question. I'm not sure if we can answer this one, but so it's better to hold options than stocks, especially if the market falls quick and drastic, as in 2008.
So better is a tough one, and that's why I wanted to compare and contrast the two. So let's take that example where you bought 1,000 shares, or excuse me, I keep talking 1,000 shares. You bought 100 shares for 20 bucks, and 1 month later the stock is at 17. The only and so you're down 300. Now let's take really 3 scenarios here. First scenario is that you're down 300 and you say that's okay. The stock's going to come back. It just takes time, but you're wrong. And it keeps going down. It goes 17, 16, 15, 14, 13, 10. If it keeps doing that, then I think everybody would come back and say, yeah, the option would have been better because that stock could just keep going all the way to 0, right? And it has happened. I mean, let's face it. We've got in the U.S. General Motors went to 0, AIG, Enron, American Airlines, right? I mean, we know all that stuff. So that does happen. People, and I've worked with people for 2 decades that say, no. This will never happen. GM will never go out of business. American Airlines will never go to 0. And when I lived in Texas and I worked with people that worked at Enron, they would say, it'll never go to 0. It'll come back. It just may take longer. And then they don't. That's one example where I think someone would say, oh, definitely better to have a call option. Let's take another example where instead of the stock going down, your option expires, and then you come back a month later and you look at the stock, and instead of being at 17, the stock has gone to 25. And then, of course, you'd say to yourself, oh, man, the option was a mistake that I bought the option. I wish I had the shares. So the only way you can really say better is to know exactly what's going to happen with the stock. You know, that whole crystal ball thing that none of us have would be the only way to say it. Now, the way that I look at this is that if my goal is to have unlimited upside, so in other words, maximize my potential but minimize my loss, what we're looking at with this example is a potential $50 loss, but the upside is unlimited. Now, granted, it's only a 30-day option, but it has unlimited upside. So I like that scenario better. But remember, the break-even point of the stock was $20. The break-even point under our example of the option was $20.50. So the only way I'll make money with the option is it must go up in 50 cents on a $20 stock. You know, if I could do math in my head right now, but it has to go up a certain percentage before I make any money at all. So if it goes up, I make money. If it goes sideways, I lose money. If it goes down, I lose money. 2 of those 3 scenarios means I lose money, but I lose less money. So you got to balance those out. Better, wish I could say. Keep going, Khalif.
One last one is, Steve, just looking for some quick clarification. When an option expires, and he's looking at the commission at expiry. He's wondering if he's obligated to buy the shares. Am I out of the option price and committed to 100 shares, or
Well,
when it expires, I'm only out
yeah.
the cost of the option?
So you are never obligated to do anything. I think what your question is what happens if the option is at the money at expiration and I don't close it out. So I gave two examples of this. One is that the stock is at $20.15. So what do you need? What do you need to do in that case? Well, if you don't wish to buy shares at expiration, then you need to close it out. So the reason you're closing it out is not to capture a profit. The reason you're closing it out is you don't want to spend the $2,000 over the weekend and end up on Monday being the owner of 100 shares. So you close it out. Now with some U.S. firms, and Conleaf, I'll refer to you back on this one. With some U.S. firms, you can call the broker and say, hey, it looks like this option, this call option, is going to be in the money at expiration. I want you to not exercise. In other words, I'm going to just give up that $15 profit, so don't do anything. Now, that is the case with some U.S. brokers, that they'll do that. But remember, by doing that, you're leaving $15 on the table. You know, same way, like if you bought yourself a six-pack of soda, and each of those bottles had a 5-cent redemption value. I'm sure in Canada it's the same thing as it is in the States. You could throw that bottle in the trash, but you are throwing away 5 cents. Or you could take it and get it recycled. So in our example of the stock at $20.15, if you say do not exercise, you are throwing $15 away. So that's why I suggest, look, there's $15 in here. I know it's not profit, but close it out instead. Now, maybe the commissions would take up the whole thing, and Conleaf, it'd probably be best that you answer the commission side of that, or the exercise side of that from a fee perspective. But again, you're the one that has the right and not the obligation to decide what you want to do.
Great. Thank you so much. So Sean, you are correct. Scotia iTRADE does support that option. If you can actually call us on expiration date after 3 o'clock in the afternoon, and say do not exercise my option. So you're in the money option. The holder of that option does have the ability to call in and says do not exercise. We do support that.
And I would imagine that if you call in and say, hey, you look, the stock's at $22, so the option would have $2 of value. I would imagine that the broker on the other end of the phone, he or she, is going to say, no. Your option's worth $200. This is a profitable trade. You know, don't do that. That's a mistake. Liquidate that option instead. So, you know, I would imagine there's going to be some rationale on the other side of the phone call, because again, options throw people off. They start thinking, I have to do this or I have to do that. No, you have a right to do something in the examples that we're giving you here.
Great. Sean, I think the audio is going a bit.
Okay, let me quickly log in and log out, and then we'll come back and we'll do a quick demo.
Okay, great. Thank you.
Conleaf, any better?
Yep, much better.
Okay, great. So let's go ahead. I want to show you some things here. So I went ahead and logged into Scotia iTRADE. And again, you could do this as well on Flight Desk, but let's keep everything simple here. So let's say I want to get a quote on, I'll keep it simple. That way we're not talking about the stock I'm picking. So I'm just going to pick the S&P 500 exchange traded fund. So I typed in the symbol, and you can see, I'm hoping you can see. I'm going to click on the option chain. So as this comes up here, you can see it gives me a quote on the S&P 500 to 43.36. And then if I come down here, you see I've got both calls and puts, and I can sort it out. Remember, I mentioned that there are weekly options, so on and so forth, but I'm going to sort it out by month. We're going to look at all strike prices. You can see I could look at in the money or out the money. And I don't want to look at a June expiration. Let's go out a little bit further than June. Let's go out to about a month. So we'll look at the July 5th expiration. And we're looking at monthly options, but you can see I also have weekly options or quarterly options. Let's just go ahead and look at the monthly options, and I'm going to get the option chain. Now remember, the stock is trading at 243. On the left-hand side, I have the call option quotes. On the right-hand side, I have the put option quotes. Let's ignore the put options for the time being, and I can sort it out by just call options, so I'll do that. Call options, July 5th expiration, and I'm going to get the chain. We'll try to keep the data nice and simple here. So I have a couple of choices here. I have, remember the stock's trading at 243, so which call option would be closest to being at the current stock price? I have a 240 and I have a 245. Notice I do not have a 243. So the closest to being at the money, I would say, is the 245. Notice that there is a bid price of 98 cents and an asking price of $1. So if I were to buy this call option, the sellers are saying, we want $1. We want $1 for it. So if you buy one contract, it would cost you $100 plus commission. Now, the spread here is not so bad. 98 cents is where people will buy from you, and $1 is where people will sell to you. Now, if I buy this one, how do I calculate my break-even point? Now, let me show you a cool little tool here. Right here under Analyze, if I decide to buy this one, and I'm not saying that's the right one to buy, but this will be the most basic example to explain it. What am I really buying? I'm not buying any intrinsic value. I hope there will be intrinsic value by, what are we looking at, July 5th. But I'm really only buying time and hope. So time and hope, if I click on this, if I click on the Analyze tab, it'll take a second to go ahead and pull it up. But I like what this shows. It shows the current price of the stock. If I buy this call option, which is the July 245 strike price, and if I were to come in and pay for this thing, it will help calculate for me, if I go down a little bit further, my profit and my loss. So I've got that set up right here. Gives me the bid, the ask, and the volume traded today, 264 contracts. The high and the low, don't worry so much about the high and low. Instead, focus on what the current bid and ask are, as that's the state of the current values. The high and the low, whatever. That could be 10 minutes old, that could be 10 days old. But we've got volume. Open interest is the number of contracts that are out there. The more contracts that are out there, the tighter the bid-ask spread is going to be. Now, the one thing that I want you to take note of here is something under the Greeks column, which is called the delta. And the delta is going to be the expected move of this particular option relative to the move of the stock. So if I were to buy this option right now, and then in the next 10 minutes, if the stock were to go up $1, the option is not going to go up $1. It should go up by about 37 cents. That's what the delta is indicating to me, is the relationship of the option to the movement of the stock. Let's take the same example, except to say that I bought the option and I paid for it $1, and as soon as I buy it, unfortunately the stock goes down $1. How will the price of the option change? Well, it will change by the amount of the delta of 37 cents. So notice that. So this option, this slightly out the money option, I want to go and say, why would anybody come in and instead of buying this option, why would they buy something like the 235 and spend almost 9 times as much money? And here's why. If I were to go in and buy this one, if I click the Analyze tab, there's a couple of things I want to show here. And Conleaf, hopefully we're okay on time here, because I want to show how you would enter the order as well. It may take me 3 minutes to do that or so. So by buying what's called an in-the-money option, although you're spending more money for it, the break, which of course means you have more equity risk, and I'm waiting for this to load, the break even on this option, on the in-the-money option, is going to be lower than the break even on the out-the-money option. So look at the delta here. The delta here is 0.957. So if I were to buy this $8.84 option, which is more expensive, but if the stock were to go up $1, the expected move of this option is 95 cents. So this option will look and act a lot more like share ownership versus option ownership. So the more I go in the money, the more the stock is, the more the option is going to move relative to the stock. So if you're right and it goes up, great, you're going to capture more of the movement. But unfortunately, if you're wrong and it goes down, you're going to capture more of the movement as well. Now, the other thing that I wanted to point out is going to be the break even of it. And the break even of an in the money option is going to be lower than an out the money option. So let's just say that I was interested in buying this option right here. Let me go through. Let's say I'm interested in buying the 240. So we'll go in the money just a little bit here. And I'm going to drop down here to trade. And I'll walk you through it real quick. So I've got the symbol for the underlying, and I'm looking at the U.S. market. I'm looking at a call option. I'm looking at the July 5th 240 strike price. This is the price of the stock. This is the price of the option I'm looking at. And my order type is going to be, is if I'm entering the option, I am buying to open the contract, and I'm looking to just do one. That's the smallest amount I can do. And for me, I do not like market orders on options. I'm fine with market orders on stocks, but I personally prefer to dictate what I'm willing to pay. So I can see here that I've got a bid of 418 and ask of 422. So the spread is a couple of cents wide. I'd like to see if I could get it maybe right in the middle. So I'd be willing to say, hey, I'll pay $4.20. Now remember, that's per share. If this trade were to execute as a day order, the cost of this option would be 420 US dollars plus my commission associated with that. So that's how I would get into it. Now, I could guess that this has a delta of about maybe 0.6. So as soon as I buy this thing, I'm participating on about 60% of the movement of the stock. And if the stock were to keep going up, then I would increase my participation rate from, let's say, 60% to 70% to 80% to 90%. And then as it goes more and more in the money, as I was showing you with that more in the money option, then I'll be more and more involved in the movement of the stock. And the opposite is true as well. If I buy this option and it starts off with a 0.6 delta, if unfortunately it doesn't go my way and the stock begins to fall, then the delta would change from maybe a 0.6 to a 0.5 to a 0.4 and a 0.3. So to sort of make a finer point on that, when you buy a call option, and you're right, you start making money, or I should say, you start making money slower and then you make money faster and faster. On the first dollar you make 60 cents. Second dollar maybe you make 65 cents. Third dollar you make 70 cents. But when you're wrong, the first dollar you lose 60 cents, which is bad. Second dollar you lose 55 cents, which is still bad but not as bad. Third dollar you lose 48 cents, bad but not as bad. So options have this unique ability to for the leverage to kind of expand and contract with the movement. So let's say you got in the trade, and going through our scenarios, it went well or it went poorly, but you're ready to get out of the trade. You would simply reverse the trade. It's the same setup. It's the call, it's the July 5th option, it's the 240 strike, but instead of buying to open, now you want to get out of it, take your profit, take your loss. You would simply sell to close. Same thing, limit. Now looking at the limit price, remember the bid is where people are willing to buy it from you. The ask is what people are asking you to pay them. Again, I would try to split the bid ask and try to get the transaction done for $4.20 under this example here. Hopefully that gives you a little bit better idea. Again, you can go into the quotes and research and start to get the option chain. Like here's one on Apple. And then if I click on that, you'll see down below option chain, and I can go from that point. So in future webinars, now that you sort of understand the basics of calls, then we can start talking about Why would I buy more time versus less time? Why would I buy in the money versus out the money? So we can start to piece together why options chains. If we take a look at how wide, why would somebody come in? Holy smokes, I can't believe there's actually a $2.50 strike price on Apple. Why would anybody come in and spend $153.30 per share in which you have a strike price of $2.50? There are some strategic considerations behind that. It's just something that we could tackle in the future. But hopefully this gets you a general idea and understanding of how to look at call options and how you could potentially utilize them as a stock replacement strategy. Conleaf, I'm 6 minutes over. I knew I would be, but let's see if anything came up in the interim.
Okay, thank you, Sean. There was a question that did come up. This would be, oh, very complex but learnable, Steve. Thank you, Steve. So no other questions at this point.
Okay, great. Well, I hope that gets you started. And yeah, Steve, I go back to when I first started learning options, and it was 1995, and I got to tell you that after sitting in class for 2 or 3 days with this stuff as I was studying to be a broker, I was pretty sure this wasn't for me. my mind was hurting in trying to understand all the language. So I think it's a matter of sort of introducing the concept, thinking it through, getting that seed planted, and then slowly learning the concepts. There are a lot of variables that you can consider, but the general premises of why you would buy a call option, we really did cover in this session. The idea is you think something's going up, you're trying to limit your equity risk or leverage the money in your account, so you're going to utilize an option as a stock replacement strategy. And if it goes the way you hope it does, you could realize some extraordinary profits from relatively small stock moves. If it doesn't go the way you anticipate, well, that's not good. You're going to lose money, but at least you've already defined how much money you'd be willing to lose. And in the example that that we were using with the 50-cent option, it's $50. It's $50 is what it is, but stock does need to go up for you to realize that profit. With that, I'll go ahead and wrap, and if there's any other questions, I will see if I can answer them electronically. Otherwise, I'll go back to mute, and thanks for having me on, everybody. And Conleaf, thanks again for inviting me on to talk about stuff that I love.
Thank you very much, Sean. That was a very interesting presentation. I think we learned much here today. So let me just wrap up our presentation. We are over in time a little bit, so I won't take much more off your time. We do appreciate your patience. As you exit the webinar, you will note a short survey will load in your web browser. If you could just maybe attend to that and indicate to us whether or not the information provided here was useful or to your liking, to your benefit. And also, if there are any other topics that you'd have us present, those are always great feedback, and we do tend to look at those to guide our future offerings to you. As mentioned to you at the beginning of the presentation, we do have archived webinars available on our YouTube channel. Just go to the YouTube channel under Webinars on Demand. Failing that, you can always email us at education@Scotia iTRADE to request a copy of recording links for presentations that you may have missed. So coming up next, we do have some of the webinars available on our events calendar, one of which is on June 20th, Tuesday, June 20th. Pro Markets advisors will be again providing for us a webinar, My First Stock Trade. So this will be for those who are just starting out. And I'll just go through some of the strategies and definitions for stock trading. Great presentation. Following that, on Thursday, June 22nd, the Market Guys will be providing some technical analysis webinars, information, triangle patterns, and wedges. So we invite you to go to our events calendar under the Education tab on scotiaitrade.com and register for any one of those webinars that you may see available. And also for the put options, you may find we have webinars there as well that are going to be coming up, so you may want to register for those as well. So therefore, on behalf of Scotia iTRADE and the Client Education Department, I would like to thank Sean Howell for that very informative presentation, and I would also like to thank you, our attendees, for your patience and your time, and for your cooperation. What I'm going to do now, as a matter of fact, I had mentioned at the beginning of the presentation that I would upload the deck. We did note that there was some information that needed to be updated. So what I'm going to do is email those out to you specifically within about a half an hour or so. I'll email the deck out to you, and then tomorrow, mid-afternoon, you'll receive an automatic link to the recording so that you can actually follow up with both of those. So thank you once again for your time. We do apologize for having gone over, but we hope that the information shared was very useful to you. Have yourself a great afternoon. You'll see my email coming out within about a half an hour. Thank you.